You're listening to AI Prism from Seoul Economic Daily.
New risk in what you're holding. It's Thursday, July 2. Let's look at what this means for retail investors in Korea.
Yeah, let's get into it.
Today, we're taking a deep dive into some recent Seoul Economic Daily reports to evaluate whether, June's historic market swings actually changed the near-term risk profile for your ETF and KOSPI holdings.
And I mean, the sheer scale of June's volatility is really the best place to start. So in June 2026, retail accounts faced 1.1228 trillion in forced margin liquidations.
Which is what, like 800 million US dollars?
Exactly, roughly 800 million. And that makes it, well, it's the largest monthly total this year, by far. Concurrently, the VKOSPI, which, measures market fear and expected volatility, it spiked to 97.78.
Wow. Wait, 97?
Yeah, it's the absolute highest reading we've seen since the 2008 financial crisis.
That's just wild. And those liquidations, they're driven by the practice a bit too, right? Like retail investors borrowing money to ride a stock rally.
Right, leverage trading.
Yeah, and then when the market suddenly turns, brokers trigger bandemimeme or automatic reverse trade liquidations. So instead of, a simple mechanical trapdoor opening, it's more like a bank abruptly seizing your house to pay off your mortgage, but they do it in the middle of a neighborhood fire sale.
That is a perfect way to put it, yeah. They just automatically sell your shares at the worst possible market price just to cover their loan.
Right. And June saw 3 incredibly rare KOSPI circuit breakers, where the exchange literally halted trading to stop that exact bleeding. So my question is, do those 3 circuit breakers mean the worst of that cascading sell-off is finished? Or is that mechanical trapdoor simply, resetting for another drop?
Well, the underlying volatility hasn't vanished. But the pain of those liquidations is really forcing capital to find safer, less crowded valuations. We're seeing a really stark rotation right now.
Okay, what kind of rotation?
Well, for one, TrendForce just raised its Q3 2026 PC DRAM price increase forecast to a pretty significant 15 to 20%. But the money isn't just blindly flowing back into tech.
Right, it's going elsewhere.
Exactly. Look at the industrial side. HD Korea Shipbuilding just locked in $15.72 billion in first half orders. So capital is fleeing over-leveraged sectors for tangible, locked-in backlog.
No, that rotation actually perfectly contextualizes Michael Burry's latest move, because he just shorted semiconductor ETFs immediately after Samsung and SK Hynix announced that colossal 800 trillion domestic fab expansion.
Which is about $571 billion, yeah.
Right, massive. And at first glance, building new factories sounds bullish,
Yeah.
But a massive capital expenditure like that can completely drain near-term free cash flow.
And eventually flood the market with way too much supply.
Exactly. He's betting that this peak investment is actually a signal that the cycle has topped.
Precisely. Large investors recognize that buying into tech right now means taking on major valuation expansion risk. You're buying the stock simply because the hype made it incredibly expensive, not because the underlying company is actually generating more money to justify that price tag.
Yeah, that makes sense.
Which brings us to a major catalyst this month. The anticipated Korea Green Transformation Policy announcement in July 2026. It's going to determine whether the power and renewable sectors qualify for targeted government investment support.
Oh, gotcha. So rather than risk a tech sector that is, cannibalizing its own cash flow, institutional money is front-running this policy announcement.
Yes, exactly.
They're betting the government is about to guarantee funding for power and infrastructure.
Right. And the $800 million in June forced liquidations proves that holding a leveraged semiconductor-heavy portfolio carries real asymmetric downside risk right now.
Yeah, a risk that has already materialized in actual wiped-out retail accounts.
Right. So what matters near-term for your ETF positions is monitoring whether July DRAM contract data actually validates that 15 to 20% increase forecast.
Because if it misses, tech could slide even further. And I'm guessing we also need to keep an eye on that fear gauge.
Exactly, the VKOSPI. You want to see it normalize below a reading of 40 to signal that the broader market conditions have genuinely stabilized.
Okay, so the underlying AI narrative hasn't ended, but valuation expansion risk is actively rotating away from crowded semiconductors and towards shipbuilding and power infrastructure.
Yeah, you just have to follow where the risk is shifting.
Which leaves you with a final thought to chew on. If a legendary short seller views a historic $571 billion domestic expansion as the beginning of the end, is unprecedented corporate investment actually the most reliable indicator of a sector top? Keep that in mind next time you look for the new risk in what you're holding. Thanks for taking this deep dive with us.
You've been listening to AI Prism from Seoul Economic Daily.